Hi, good morning, everybody. Thank you all for joining in. So today's topic is NFOs. Surprise, we're not going to look at the best NFO. We are going to be looking at, what has been happening in the NFO market. Yeah, there are very good products. Maybe after the session, you can put it in the Q&A and we'll have a discussion on it. But verbally, we do not want to say that, yes, this is something that, you should be doing. There are very, very good strategies that we are tracking. And disclaimer here, Milestones2Wealth does not do NFOs. We do not participate in any NFO for that matter. But since the market is developing, there are many new strategies that are coming. We keep a track of them. Once we understand that, yes, the portfolio has been built, the strategy, there's a good character to the portfolio based on the particular strategy, then yes, only when it fits within our style, it does come under recommended list, right? But we'll have a very good, fruitful session on what's been happening on the NFO side. Okay? Q&A, you take up whatever NFO that you want to discuss, and I'll be very open in terms of some level of information more than what I can give out. Yeah. Okay. Okay, two mandatory slides always. Market cycles. Market cycles are always periods of over optimism and over pessimism. Uh, in terms of over optimism, you will always see more NFOs coming in. You will always see more IPOs coming in. And in this period, we've seen a lot of NFOs coming in. I'll get to the number once we go ahead. But market cycles go from very, very good to very, very bad. And that takes about 3 to 5 years. Longer ones are, of course, 10 years plus. There is a trend to this, right? So whenever you see, a lot of people getting more and more interested about, stock markets, wanting to make money, you see everybody else posting and flexing about how they're making a lot of money. That's definitely a great scenario. And that's where you have to be cautious as a saver in India, right? Any market, you have to be very, very cautious, right? Fear is where your participation levels as a saver in that particular asset class goes up. Now, when we talk about asset class, they're different. So you have equity, you have debt, you have precious metals. So every asset class has its own cycle. Okay? So right now we are in a period where we are more on the greedy side, and you're seeing that Nifty has been trading at premium multiples compared to its history, plus compared to other developing nations as well. So that's why you're seeing a good amount of pessimism starting to come in, right? Whereas when you're on the fear side, asset classes that are on the fear side, that are shunned away, that do not want to be looked at, they are precious metals, they are debt. So that category is going through a phase where, yes, if there is a big merit to it, definitely participation levels need to be very, very high, right? So what does Milestones2Wealth do, right? Milestones2Wealth does exactly that, where we, based on your risk appetite, based on your financial health checkup, right, there is a tailor-made solution that has been given to you as to what you can do at every market, how you can save in these particular asset classes. And the modes are, of course, lump sum, SIP, and step up. But the main thing is what you would not get, what you would get compared to that of a broker is that nobody is going to call you and tell you that, hey, this stock has gone up, this stock is down, you should do this and you should that. No, we do that. It's not based on stocks, but when your participation levels need to go up, what you need to add, what you need to sell, when you need to sell, right? So those are the qualitative work that we do for you. Based on your risk appetite, everything is tailor-made for you. So something comes to me and something will come to the other person. Okay? So that's the level of work that we are at. Okay? So everything will be tailor-made for you. Okay. Once your goal is being met, definitely that is a period where we reap the benefits. Second case is where markets have peaked out. So we had a period between May where we were reaping benefits very, very well, right, across the house, where we did take significant sell calls, and we are majorly buy and hold. So you would not see us change. It would take 5 years or so, 4.5 to 5 years for something to play out, and then you would see once it starts going to a level of overvaluation is where you can reap benefits, right? So two cases of where we reap the benefits. One, when your goal is very, very near or your goal is met. Second, when there is extremity in the markets. Right. Now, what is NFO? Right. A new fund offer. What I want you to see is that NFO is used to raise capital from the public to purchase securities. So this is not an IPO, right, where you get to see fundamentals of the company and they raise it for other things, right? Here the NFO is raising it to buy equity shares. So that is one thing that is the standout factor between this and IPO. So do not compare this to an IPO. Do not mistake IPO returns to come for NFOs, right? NFOs are very, very stable. Right, mutual funds are very stable. NFOs, yes, they would get to some level of stability after some time, but the main purpose of an NFO is to raise capital from public to purchase securities. It can be debt, it can be any security that is listed, it can be gold, it can be equity. But the main thing is that yes, they have a particular strategy and they will only buy based on that particular strategy. Now, let's understand NFOs, right? First thing always is that you need to study the presentation. You need to spend some time where you have to go through the entire presentation, not once, but multiple times, because there are four parts, right? First one will be your introduction of the theme. So let's say we are looking at innovation fund, or we're looking at digital India, we're looking at a particular EV theme, right? So the main thing, and this is so these two are the most, part A and part B is the most important. Part C, I would say, is to lure you in, right? And part D is of course the fund manager, where the experience of the fund manager and the AMC definitely plays a huge role in how that fund is, what is the mentality behind that particular fund, right? Why have they launched it? Right. So you see a lot of momentum driven funds coming out. You see a lot of innovation driven funds coming out. You see a lot of momentum quant driven funds coming out. Then you see certain themes like infrastructure coming out. You see certain themes like digital India coming out. Then you see a consumption. Then there is global, right, where they talk about new age technologies and fintech, right? So spend a lot of time studying the presentation, because part A is the most important. The data that they give out in part A would be about for 5 slides, right, where they would highlight why they want to start and create an issue out of this particular theme. Issue means NFO, right? So why do they want to come out with this particular NFO for this particular theme? So spend a lot of time on that, right? Then part B is investment style and philosophy. This majorly, if it is a momentum, if it's a quant based fund, or if it is a momentum, if there is a factor, let's say low volatility, uh, or quality 30, there you would see a difference in terms of the style and philosophy. But otherwise, this would have been the style and the philosophy that the AMC follows as a house, right? So they would have certain checks, parameters, metrics that they look at, right, which will be highlighted to you in this particular site, which is very, very important again, right? Why? Because you need to know what the fund house stands for, whether it is going to fit within your risk appetite, your risk profile or not. That's the most important part, right? Now, the third one is the most deceiving part. Most back tested performance is outperformance, right? That's because there is a survivorship bias when it comes to back testing, which means it only includes the ones that are currently there in that particular universe. It does not include the ones that have gone out. Right. So there is a big problem when it comes to backtesting data. So whatever the published data is outside for backtesting based on that particular strategy, there is not a single rupee of money that is being put out. That's why they are raising money from you so that they can put it in reality. But reality is completely different. We'll get to reality later as well. Right. So don't get deceived by backtested performance. For one single reason, yes, the universe that is there has a survivorship bias. Whatever has been left out, whatever survived is only coming in. What have been loss making, delisted, gone out, nothing comes. Right. So obviously there will be an outperformance to the benchmark. And the fourth one is your fund manager profile. Your fund manager profile is important because you need to understand the experience and the record of the fund manager. That's a very, very important part as well. Right? But priority is very, very simple. Look at the first 5, 6 slides multiple times. Do your own study before you get into style and philosophy. Right? Spend a lot of time on part A. Right? Then go at part B where you understand, okay, how they are planning to invest in that particular theme, right? What that particular strategy has done for them and that particular style is irrelevant because not a single rupee has gone into that particular style. Not there. So there is a reality check that has to take place once the portfolio is being made. And this is what we do. We wait for reality checks to start coming in at Milestones2Wealth. Right. There is some cases in which you do not need a reality check. It's a passive fund. It's a very tactical approach. You can go and do that. You can go and do it. Beware that yes, when you buy at high valuation, usually there is a trend of consolidation and time correction. But only in the case of a passive theme, right? Where there are very, very good ideas that are there in the market, and you can use it as a tactical approach for your portfolio. Right. And this is what we are also doing. If it does have a complement to the existing investments that are made by the investor based on the risk profile, then yes, it would start coming in. But that also we would take time for some reality checks to kick in because it's more to do with the index and the construction of the index at that point. It's not to do with the theme, it's not to do with the style, right? It's more to do with how the index is being constructed at NSE level. Right. And when there is a rebalance that's taking place, what are the changes that are taking place in that particular passive index? So we would wait for some amount of reality check to come. Right. Then we will go to another question. So how many NFOs have been issued this year? So you can put your answer in the chat box. How many NFOs have been issued and launched this year alone? You can put your answer in the chat box. Okay, I did not. Okay, if you raised your hand, I'll give you mic access. Hey, Gopi, can you give the mic access? A, B, D has come. One C is missing. Okay. I've given, Mr. Ganesh, I've given you mic access since you've raised your hand.
Yeah, chat option is not available.
Okay, chat option for you is not available. No problem. Gopi, can you just make sure that so I'm getting the votes, but you just check for the chat option, no? Okay. So in terms of A, B, D, okay, only one C is not there. So let's look at the actual number. Okay. All of this is public data. There's nothing that extra that is going to come. So since the information that is available to you, I'm only going to be talking on that. Right. So the Indian mutual fund industry is experiencing a surge. Yes, with over 180 new launches in the last financial year alone. So yes, there have been somewhere between D, right? I would say mix of C and D because yes, this includes some from the last financial year as well. But this year, yes, there is about 160. There's about 160 alone that has come in this year, and we've collected. The industry has collected 75,000 across active and passive, right? So where's most of the money going this financial year? 54,000 has gone in just into in this financial year, with 22,000 going into thematics, right? Thematics. So a lot of money has been going into sector and theme. And usually in a bull market, you would see a lot of innovative products that are coming out, majorly with whatever is trending. So in 2017, 2018, it was small caps. And now since it's more sectoral and thematic driven, you will have more. Now, why is it that there is more sectoral and thematic funds that are coming in? Right? One is that they have done well in terms of performance. So if you see infrastructure funds, if you see public sector oriented funds, you see that they have done phenomenally well, right? Then you see in the in 2021, 2022, IT was speaking out. So IT also had done well after COVID, during COVID, right? Then you had pharma, and now pharma again as a dark house has done very well. So sectoral and thematic funds have done very, very well compared to broader indices. And what I've showed you now is the net inflow for every financial year, right? So if you see, 2023 was not a very strong year in terms of net inflow, but performance wise, they had done extremely well. So we have done multiple webinars on themes where we published that data. It's public data, so you know how they have done. And we've also, as part of Milestones2Wealth, have had sectoral and thematic fund recommendations to our investors. But if you see in 2024, 2025, a majority of the money that has come into our system has gone into sectoral themes, right? With a big propellant being NFOs. Right. So basically, all the money that has been coming in raised is untested. There's no, so reality checks still need to come in. It's untested. It's not. Based on back tested data, and it's based on the returns that have come in before as a reality check. Right. So past reality has been, yes, they have done very well, but going forward, we do not know how they would look like. So if you see broad-based indices like large caps, there has not been money in the last financial year, but this financial year slowly inching up in terms of money. Mid cap, small cap still receives a lot of money. And if you see the drawdowns in mid and small caps, you will get a lot of acidity. Then in terms of multi-asset, yes, multi-asset also has received a lot of NFOs. But since we're dealing with equity in this particular presentation, I will not look at multi-asset. But multi-asset has received a lot of flows. Again, their propellant has been NFOs. But multi-asset as a theme is far more conservative than a sectoral or a thematic fund. Right. But whatever NFOs have been coming now have been coming based on and been going into sectoral funds based on the performance that has been coming. So if you say net inflow, and that number was just proving it to you, 47% of all the flows have gone into sectoral and thematic. Right. AUM also has been about 4.67 lakh crores. Let's look at the number of funds, 185 funds that are there. So almost, 25 funds being added just in the year alone, this fiscal year. Right. So there's a lot of innovation on that side. So how many of you have invested in any NFO? Have you invested? You can put out the name also. It's okay. Immediate no. Okay. Okay. Big no. Okay. Not sure how to choose. We have one slide in the end of how to choose. And I've given you some certain points of what you should actually spend some more time on. Yes, you invested in 5. Please put at least 2 names. Or if you're comfortable putting all the 5, please put all the 5. Okay. So we have multiple no's, which is a good thing, not by virtue of, yes, you are taking some time for the portfolio, but yes, you do not know how to select a good particular NFO. But the point of an NFO, which is the last slide, I'll show you what you should be choosing. Are NFOs same as IPOs? No, definitely not. Right. So if you see what is the difference between NFO and IPO, see the expectation that you need to have is that IPOs, you're getting ownership of that particular business. NFO, you're only going to be getting units, right? Because they are raising money to buy shares outside whatever is listed, but not ownership. And when a company is raising money, uh, usually it will be either they want to put up more capacity, or it can be for very short term needs, or second it can be to pay off debt. It can be anything, but there is a particular need of why they are going out and doing that particular offering, right? So if you see pricing, NFOs are very, very expensive, right? NFO expense ratios can range between 1.5% to 2%, right? So when that argument comes of I would like to buy funds that are only low expense ratio because the return expectation will be high. That's not true. In the NAV itself, whatever is there, it would be captured on a daily basis. But NFOs are very, very expensive. So it's all AUM based, and they're all new. So they would not raise very, very high AUM levels. They would not be able to raise so much of money as well. It would take them some time to raise money, some time for the expense ratio to come down. So all of it is more AUM based. So higher AUMs would have lower expense ratio, and lower AUMs would have a higher expense ratio. That's the mandate, right? So pricing wise, IPOs are priced based on fundamentals. There's a lot of work that goes into it. There's an investment banker that spends some time to overprice the IPO, but here there is no actual value of the investment. It just starts either with 10 rupees or 100 rupees, but you start getting units at that price. So you do not get ownership, you just get units of that particular mutual fund. Right? That works just like a similar, what other listed mutual funds that are there. Right? Performance. Now, this is the most important part here. For an IPO, you get certain level of information of past history that they give out in the draft to show you that yes, this is what my company has done, and I'm offering ownership to anybody who wants to participate because I need to raise capital to further grow, right? But for NFO, investors do not get to see the company's past performance and other measures to evaluate it. So all of that back tested data that's there, has a lot of bias, does not get fully tested out when the fund is launched. So what you see, there's no past performance, there's no record of that. The only record that you get is of the fund manager, not of the particular strategy, not of the particular idea, right? You would get back tested data, index data, benchmark data, but most important for an active NFO that's there outside is the particular strategy and how that strategy fructifies into giving investors performance. Right. Now the listing price again depends on the investment bank for the IPO, which is completely different. So what I'm trying to highlight is that do not have that comparison itself. It is separate. Right. More and more, what I see is that investors are thinking that you will start getting what you got as 2 years back as 60%, 50% return on an NFO. No, that was in a bull phase. We are not in that bull phase anymore. We are in a long-term bull phase. We are not in a short-term bull phase. Right. So NFOs reflect the securities of the recent market value. So yes, listing price will be 10. It's very, very simple. But for IPO, it's completely different. Right. Now, the usage of funds, most important for NFO is that it capitalizes on the trending theme. It's very clear, trending theme, right? So whatever is in fashion, like fast fashion, gets pushed out in the market to raise for them to go and invest. So if you look at what's been happening on the defense index and the defense fund, you would know, yes, all of it is a trend. Though the theme has been spoken about very, very optimistically. If you see what's been happening in the last couple of months, particularly for that index and that active fund, you would know that yes, all of it is on a trend, right? So wait for trends to settle, wait for sobriety to start coming in, and then you can start picking up NFOs at good valuations. right? Valuation NFO total fund is split, so nothing to do here. But over a period of time, as the portfolio starts getting built, you would know what is the valuation of that particular fund, right? Risk NF NFOs, you see that the risk is somewhere between medium, but I would say that the risk is high because you don't know what you're buying. You are just giving them money and they would go and start buying and take couple of months to fully deploy that money. You do not know what they're going to buy. You're just buying a particular strategy which is very, very expensive and no track record. Right? So you do not even know. So when we are discussing this internally with Sham sir, he just stumped us with one single line saying, will you marry someone without seeing them? Definitely, times have changed, and that's not going to happen, right? So I would say that for investors who have a very high risk appetite, who are willing to invest blindly, this is for you. But I do not think that even a risky investor should be that blind. Right? Now, do NFOs perform well? Now let's get into the performance part of things. Right. So this is from Funds India. It is an article on CNBC. It's all data that's relevant and available to you. It's not something that there's a need to calculate. Right. So he says that out of the 110 NFOs that were launched between 2019 and April, 62% have underperformed the benchmarks. So you're paying more. You don't even know what you're paying for. You don't even know what. I mean, you're going very blind. You're taking that level of risk, thinking that you'll make money based on 2 years of market performance, but you still underperform the benchmark over a long period of time, right? Then 26% of NFOs end up in the top performance quartile. This is excluding sector and thematic. So actually, there is a good chunk of new funds that do come out, right? That over a long period of time, say 3 to 5 years, have done very, very well. This is excluding all the trendy parts, like sector and thematic funds. They all trend. We forget the trend, but inherently there are funds that are doing very, very well in terms of that particular strategy. Right. So that part is what we look at and we try to evaluate to see if we can do it. Right. In our universe, there has been one that has come in based on the particular strategy that has been working. And yes, it at one point definitely was a recent NFO. Right. So yes, there is a part of the market that is worthwhile looking at. Right. And that keeps changing. It's not the same thing over and over again. Right. But there are some certain strategies within diversified, right, which means large and mid, flexi, focus, and multi. This is that part that is actually uh, doing well, where strategies are working out, and that's why you see top performance quartile coming in. Right. So now let's get into how do you go with investing in NFO, right? First, I would only say choose experienced fund managers and fund houses, right? Anybody who's new would have mandates that in this particular market or not having that much share in the market would definitely have that mandate to say, yes, now is a bull market. Please go and raise money from the market. Mandates would be given to say this number of strategies need to come out and people will go start raising money. Right. So that's why you see a lot of passive coming in, but a lot of innovative passive coming in, thanks to the number of indices that are there on NSE. They're providing that particular platform for manufacturers to come out with innovative us to participate in innovative strategy. We get that option, right? Second, understand the investment strategy and know how that investment strategy is supposed to deliver. A momentum fund is supposed to deliver only when there's momentum, right? When there's no momentum, don't expect that level of performance that came to you during a momentum time. Right. Flexi cap, large cap, broad-based strategies, is going to be more bottom up. It's going to be slightly consensus driven. But yes, that fund manager skill, this is where the fund manager skill and the fund house and the parent strength starts coming into them delivering performance. Right. NFOs are very, very expensive. When an NFO comes, just study and spend a lot of time understanding the strategy and just leave it. Let some reality start coming in. Reality is not that good, but expense ratio ranges from 1.5% to 2%. Right. Most important, do not base your decision on back-to-shit performance. Right. Spend more time on part A and part B. Right. Then when you get an option, definitely look first towards broad-based, and at a cyclical low, please look at sector thematic. Do not be afraid. But at a cyclical low, at a cyclical low, at a cyclical low, when it becomes a boring investments, your participation levels definitely need to be higher, right? And last thing, be tactical with new passive strategies. This is very, very important because passive definitely is growing, but having a broad-based passive fund will not help you out because an active fund manager is doing more or less very similar things to that of the benchmark, right? So there has to be a complement to that particular active fund or to that particular broad-based index. So that's why you need to be very tactical with your passive strategy, and you're getting more and more options in terms of investing in passive strategies. So yes, we will cover one proper webinar just for passive investments, right? But for a long-term growth, you need to have both. In certain periods, you need to have more active. In certain periods, you need to have more passive. There is no proper split to say this much has to be in my particular portfolio active, this much has to be passive. No, in different market conditions, you need to have active and passive, right? Usually, in a period where in a bear, you need a good amount of protection. You need a good amount of stability in bad periods. That's where active plays a huge role, because fund managers inherently, you're dealing with a fund house, you're dealing with 17 18 analysts and the team, and then it goes to an investment committee who takes the call. So there are multiple checkpoints, and active definitely is the preferred strategy for when we are entering into somewhat of a lull or a bad phase, because they only can protect you. And passive works very well some in a bull market when everything is doing well. So that you need to have a mix of both, right? This is just an expectation that you should have as a saver in India. So let's say, for example, you just put one small lump sum and leave the money and don't do anything, no SIP, no STP, nothing doing. Your returns over a long period of time would be between the 11 and 12% sort of CAGR range, which is very good, because when as you grow at 12%, you double your money effectively after 7 years. That's the math, right? So don't try to chase return. Even if you do not do anything on the passive side, where you just put one money and forget. So all the forget cases start seeing money only after the 11th year up. But for the first 3 4 years, you see a lot of volatility in terms of the market, in terms of the performance, in terms of experience. Stability starts coming in only later. Okay, so be patient as an investor, be patient as a saver for stability and consistency to come into your portfolio. Right. Now I'll open the floor for Q&A. So you can type whatever question that you have, and I'll do my best to address it. Okay, you shared the screenshot. Thank you so much. Yes, current NFOs are negative. Yes, so average for this year is only 4% return, and the average is being is going up because of the technology fund by Edelweiss and the pharma fund by Vito, because the theme has done well. It's protected well, and they have a good amount of global exposure, so that also has helped them out. Apart from that, the entire pact has not been doing well. So you need to give them some time. You need to give them a lot of time. Let me take out those two funds and see what the average is. 3% this year, whatever has gotten launched. Yeah, it's a new ICICI Prudential Equity Minimum Variance Fund. It's a new fund. It's a new strategy. There's only one more, two more funds that are doing, but they are also very new. So wait for some time. Both in NFO and existing fund, most of those follows doing with concentrated portfolio. Is it risky or shows their confidence? See, I told you, passive may you when you come up with innovative strategies. So there's a mid and small telecom, there's a mid and small healthcare, uh, there's a mid and small financial service, right? So there is good level of innovation that has come, right? Where there is an appetite. I would say that yes, people are looking to invest in these schemes in these themes. There is a need. There is a DSP Nifty top 10 equal weight, right? Where you have the best top 10 in terms of market, everything be 10%. So yeah, there's a good amount of concentration in the portfolios that is coming up. There is a momentum based strategy that is coming up again, where they have a Nifty 200 quality 30, Nifty 200 value 20, Nifty 500 quality 30. So yes, there's concentration that is coming out because yes, you need to have that level of confidence for and concentration for alpha to come in, right? So yes, it is risky, but there is appetite. So there are takers in the market for these particular strategies, and these strategies do work at particular periods of time. There has to be education that needs to take place, and more study and more push that comes out from the at the AMC level for these particular strategies in terms of education. It will take time, but you will see that in developed nations also you have seen this particular trend of innovation and innovative products to come out in the market. You will see that also taking place here. But it's not necessary that you go and have to participate. First, like I said, this is my list. It's not necessary that you have to go and participate compulsorily because they have done very well, or the data shows that it's very good. You have to give it some time. Will expense ratio reduce after the increase in AUM fund? Oh, maybe. See, the mandate is that they have to. That's the rule, right? That they have said. So as it goes up, the expense ratio will come down. But for that, the AUM has to go up. I think I'll add one more point in the concentrated portfolio part where if the fund house is buying more and more expensive uh, names in the fund which is more concentrated, then definitely you will have a big risk in terms of re-rating down or de-rating. Okay, can you explain the last point, please? Be tactical with passive. See, for example, right? If you have a flexi cap fund, and if you have a blue chip fund or a large cap fund, and when you buy a broad based ETF or a broad based index fund, which is Nifty 50 or Nifty 500, then you're buying the same thing, no? Because flexi cap will have majorly NSA 500 as the benchmark, and the blue chip fund would have Nifty 50 as the benchmark or BSC, whatever the benchmark is, but more or less it's broad based. So they would have very similar names to that. So you're buying the same thing. You're not diversifying actually. You're concentrating more by having three funds in terms of strategy, but you're over diversifying in terms of name, right? So when I say be tactical, then for example, if a flexi cap fund is underweight on a particular sector or a particular theme, you use passive investments and you use passive strategy to add on to that particular conviction of yours where they are underweight. So for example, if they are underweight on pharma, you can look to do the pharma ETF or pharma index fund. It's not a recommendation. See, we have done it. We have done it in the past where we've had to have a good amount of concentration level by going overweight on parts of the market that we have conviction on, where the active fund is not. right? So that particular strategy has been working very, very well. So that's why I say be tactical, right? So where they are underweight or where that you have more conviction on and you want to go extremely overweight on, please put that as a cherry on top of the cake. Please tweet that. Uh, I have no answer for that. With Sham's expertise and a great team with you, why don't you consider venturing into a mutual fund business? Because when I thought running MF, we will feel free and safe and secured. Thank you for your confidence in us, and I'm very happy and I'm very glad that you along with all our investors are feeling the same thing. You've instilled a lot of confidence. We've instilled a lot of confidence in you. There's a good amount of support that has been coming, and you see us doing this level of work. Regarding the MF business, I mean, uh, I don't have any comment also on that. It's my early experience. NFOs require at least 2 to 3 years. It's better to avoid invest prevailing fund than yeah, you could wait for the strategy to play out. Second, that is one. Second, you need to go to an advisor, right? You there are specific requirements for every person. Everything needs to be tailor made. Nothing can be done just by taking some Dolo 650 for a headache or for fever. It's like that. You're just taking a random medicine for something that you don't even know what to diagnose, right? So you need to go to an advisor to understand whether you can take up NFOs as a strategy also or not, because risk profile Indian investors are very conservative in nature, right? You in a bull market, they will be aggressive and they will take aggressive calls based on the risk appetite. But Indian investors are conservative in nature, right? Where the risk appetite is on the conservative to slightly moderate side. So by that logic, right, NFOs need some amount of time before they come into your portfolio. And for example, today also whatever funds are there, they were also NFOs only at one point. So they need some good amount of time where the strategy and they have a deep understanding of that particular strategy and how it's been working. And second, for the fund manager also to become already experienced fund managers definitely are going to have some good amount of knowledge on how to run a particular sectoral theme or a sectoral fund or a thematic fund, but you need to give them some time. So yes, it is a risky option. You are going blind into it at the on day one. Up until the first year, you are going to be completely blind, and you are going to be shown returns to say yes, we are doing very very well and all that. So but for the first year, you're going to be completely blind and you're overpaying for it. So yes, those prevailing funds also would have been NFOs at one point, which they have over a period of time matured, and that's when your participation levels need to be extremely high at that point. So always work with an advisor to know when you can take, when you should not, what you should do, and what you should not. The main thing is not what you should do. The main thing of why you should go to an advisor versus that of just opening a zero account or a grow account to do your direct or your stocks is to know what you should not do. What you should do is freely available everywhere. YouTube, now I see on YouTube, newspaper, Twitter, general meet outside, it's free. But what you should not do, that you don't get. And what you should not do, you're getting at a very, very low cost at Milestones2Wealth. It's actually free. We do regular plans. And there's a strong research backing to whatever we are looking to do. So you have to work with an advisor, be it us or be it anybody else, but you need to work with an advisor. Okay, I'll keep the floor open for another couple of minutes. So if you do have any question, anything that you want to know about a particular fund, please do put it in the chat box. I'll do my best to try and address it. And then probably if there's nothing, then we can close. I'll put the number out till then. So if you're not on the program, please get onto the program. There is a team working on each and every person. So if you ask me how many people are working on one particular portfolio, it's my team, which is strategy, it's the sales team, and it's the planning team. So there's a total of 8 people working on one particular portfolio. 8 people. How to know? See, expense ratio. See, it should not be your main driver of investing in a mutual fund. Because if you want to go and invest in a small cap stock, for example, which is not going to be liquid in nature, you're going to be paying more or less the same price because of there's no market depth. Naturally, you will be paying more, right, in the market to acquire some certain shares, right? So let it not be the driver of your decision to invest more incremental money into mutual funds, right? What should be your driver should be the strategy which we look at and the portfolio construct which again we look at, right? And we have that access to get in touch with their team to understand how they are running the fund, what their plan is to run the fund, and whether it suits the investors that are with us in terms of their risk appetite and their financial health, right? But if you just want to know what is a good expense ratio, definitely lower the better. That doesn't mean you should go for passive. That definitely does not mean that you should go for passive. We have had higher expense ratio funds because the fund makes sense as a strategy to do, right? And the outperformance also on it has been very, very large, right? So some sectoral and thematic funds like PSU, infra, commodities, and on the passive side, the active side, gold mining, they've all have been our kicker and driver of returns, right? In the past, not right now, in the past, right? So whatever we did in the past, yeah, we are benefiting it from it now. But yeah, expense ratio, it is at the bottom of our list and priority when we look at how the fund is, whether it is worth investing in a particular mutual fund or not. The reason of why I say that NFOs are more risky is because you're going in blind. You don't know what they are going to do, right? If when you come on to Milestones to Wealth, if we had not done any particular webinar or podcast or reels or anything, yeah, you would be blind. No? You don't even know who you're dealing with. You would be blind. So you're going to be blind for an NFO. So give it some time. You need to give it a lot of time. Thank you so much, sir, for your comment. I keep seeing you very regularly on all our webinars. So thank you so much for your support and thank you so much for spending time. Okay, I don't think that we're getting any other. Oh, somebody's typing. Okay. Thank you. Thank you so much for your time. I've put out the number. If you're not on the program, please get on the program. And my request to you would be, please, Gopi, if you can just put the Google review also. Please do reviewers on Google. We want to help more and more investors. So next time, please get your friends in. Share this number to your family members. Share this number to your friends. Share this numbers to your well-wishers. And we are here definitely to help them out as well. We want to help more and more people get their finances right. Where can we get upcoming webinars? OP, please, and I want to know where I can see them. Usually it comes on YouTube after the webinar is done. So you can check on YouTube. But I mean, Gopi, please help here. It comes on our Milestones2Wealth channel as well, and the PMS one comes on the PMS channel. So do spend some time there. Follow us if you're not following us, uh, and please do spread out that word in society. Right. So thank you so much for your time. Have a great weekend. Thank you.